Advanced Financial Modeling, Topic 9, Forecasting Financial Statements, Free Cash Flows, and Stock Valuation. Learning Objective Number 3, we're going to assess growth and EFN, external funds needed. So this is going to be a short one. I just want to look at two scenarios for growing your business using that pro forma financial statement we just did. The first one is I want to define something called internal growth rate. So that is a growth rate of sales in which the rate of sales growth can happen without any need for new external financing. No new debt, no new stock. Holding that dividend payout constant. So it's how much can I grow without having to issue more debt or more stock. The idea there, it's costly to go to the market and issue new stock and debt. So how much can I grow? The formula for this is going to be the ROA, return on asset, times plowback, divided by 1 minus ROA times plowback. And if I go to my model, you can see here, I calculate the number here. If I go to internal growth, I go ahead and calculate the internal growth rate. 6.03%, because I calculated my ROE and plowback down here. And then I take that 6.03 and I plug it in here. Notice I grow sales growth and short-term assets at 6%. When I do that, notice my EFN, it's almost zero. It's close to zero. We'll just say it's rounding. It's $1. So this is how much I could grow without needing new stock or debt. So that's an interesting number to look at. The other one to look at is something called sustainable growth rate. The sustainable growth rate is the rate of growth without any need for new equity, so no new stock issuance, while maintaining the current DDE ratio. So let me go back to internal growth rate and the impact on ROE. Right? Growing at 6% and not needing any stock or debt to balance my balance sheet. This firm is still delevering. Why? Well, it's not issuing any more debt. In the past, there's always been debt, and this company has both debt and stock balances to finance its growth. Just by running the business, it's earning net income and retained earnings. So equity is growing by additions to retained earnings, but there's no new debt. So what you're doing is delevering the firm. The firm is safer after this change, and the ROE is falling a little bit. But what if we don't want to delever the firm? We want to contain or maintain the same level of financial risk, and we'll call that the debt to equity ratio or the equity multiplier. Both kind of summarize that number or represent that number. And when I do that sustainable growth rate, which is ROE times plowback divided by 1 minus ROE times plowback, and I calculate that at 11.405, 11.4%. I'll go to my forecasted sustainable growth rate. I put in the 11.4% as growth and sales growth and short-term assets. When I do that, I am going to need additional funding. But again, remember the definition. It's the level of growth without any need for new equity. It didn't say new debt, but you're going to hold DDE ratio constant. So what I'm going to do is go back to my spreadsheet. I'm going to hit undo, and it looks like what I did is I had to take that $65 in EFN and add it to debt. When I did that, there was an extra $3 because of the interest effect. When I did that, there was an extra 14 cents and so on. So when I did that, well, that last one is 0.01. When I did that, if I issue $69 of debt, I balance the balance sheet. If I want to grow at 11% sustainable growth rate. But look down here, the equity multiplier and my DDE ratio are remaining constant. So this is a level of growth in which you don't issue new equity, but you can issue new debt as long as you don't increase the debt to equity ratio or the equity multiplier ratio. So that's an interesting level of growth. How much can I grow without changing the financial risk of the company? So I told you that was going to be a short one. Let's talk one more slide on what is financial planning. The objective of this financial planning is not to create a financial model. That's not the objective. The financial model is just a tool to assist decision makers to understand the financial impacts of alternative strategies, meaning how fast do we grow, how much assets do we grow, how do we finance it, do we use debt or equity. So financial planning is a very complex and requires many assumptions, and you have to work with all layers of the organization. If you want to increase sales, you need to be talking to marketing. If you want to increase production facilities, you need to talk to supply chain and manufacturing people, and so on. And these decisions have to be made at the very top. The CEO, the CFO have to all agree upon this, and they have to fit together. Meaning that the sales growth has to be consistent with the fixed asset growth, which has to be consistent with the capex, the purchases for this year, which has to be consistent with how much we're going to borrow this year and new stock issuance and so on. The alternative to not doing this process is you just stumble into the future. You're just going to spend and see what happens. All right, so in the next section, we're going to see how a plan and forecast affects cash flows, which are different than profits in the net income statement. So we're going to move on to a discussion of cash flows.